I'm Aaron. He's Adam. Recording live here at Southwestern Ontario Real Estate Forum in London, Ontario. Our guest is a repeat guest. Very happy to have Ted Davis back on, COO Canada for Avison Young. Ted, welcome back.
Thank you so much, guys. Appreciate it.
And congratulations on the expanded scope and new job titles. Last time you were on was Managing Director with a purview of Southwest Ontario. You've now expanded that about 5,000 kilometers in either direction and have a Canadian view.
Yeah, a lot more people, a lot more geography. But what is really cool about having a position like this is that then you can start to see the patterns. I mean, though
Real estate transcends borders, you know?
And that's exactly it. Yeah, it's incredibly interesting to see where, though the geography and the areas are that much different, you get into it and doing a deal is still doing a deal. And that doesn't change.
I always love, and I'm sorry, I'm going on a little bit of a tangent, but I always love, like, commercial real estate is super complex, but it's really simple at the same time, right? Like, I mean, even just like valuation is literally NOI divided by cap rate equals, you know, what it's worth. Like, it's just the most simple formula that we've based much of our dependency on.
I have been now over 20 years in the business, and still what sticks with me is essentially my first lesson in sales that came from my first managing director, a gentleman by the name of John Hare. And he goes, "This stuff's not rocket science. Just go call people and make money." Okay, I guess so.
Yeah. And don't forget the 1,000 things you need to know as you go through that exercise.
He didn't really slip that part in. He just made it sound really simple. And if you weren't successful, that's your fault. Great leader, though.
When Aaron and I were driving out to the forum today, we had that conversation around real estate. None of it's too difficult. There's 100, 200 things that go into every single deal, and every single one has to be right. No. Or there's major consequences, but none of them are too hard, but they all have to be right.
Yeah. And of every deal, those 100 or 200 things are different. Like that, it's just, that's the joy, I guess, of it. Anyway, we're going on a tangent. Back to you. So regional exposure, regional scope. Talk about that.
Yeah. So I think it's exactly what we were kind of touching on, is that you start to see the similarities. You start to see how cities are built, how economies are reinforced and grown. I think that when you start to look at a deal and the different variables that are in it, those variables, though, can change. The actual steps in order to verify them, where those factors start to come in, they do stay the same. Like, I'm a big believer in business in general. It's process that drives that kind of proactive management, whether it be trying to get sales done, whether it be managing people. Having that in place, it allows you to have less reactionary management and more so around what needs to be done. Let's get ahead of it. How do we plan? How do we take an unemotional view of trying to get things done? And with that clear head, you can start to factor in all those other variables in order to make the decision. That doesn't change no matter where you are in the world.
Are you spending more time on planes now than you used to?
I am. Yeah, I am. A lot more time on planes, a lot more time in hotels, which I'm sure my kids don't completely love. But you know what? It's great being able to go out and see everybody. And the great part about that is that it exposes me to so many different strategies, whether it be from the client side or whether it be from, brokerage teams or other professional services that we have, because AY has valuation, project management, consulting, property management, as well as brokerage, the debt side. Everybody structures things different. So it allows me almost to take a best-in-class approach. Somebody's doing something really well or has a really unique kind of secret sauce. Why is that so successful? And then how can you apply that in other ways?
Yeah, some markets can figure out things faster than others, whatever the issue of the day is.
I think that I agree with that. And I think that part of it is cultural. I actually think that that's where Canada has a leg up on a lot of people, or a lot of other countries and a lot of other economies. If given the freedom to think, I guess, entrepreneurial, to think outside the box, there are incredibly smart people in our industry, in business in general in Canada, that have incredibly smart ideas, and they know how to do things differently. The trick is being able to give the resources as well as the flexibility in order to let people do that successfully.
And we will, near the end of this podcast, talk about some of the disruptive forces that are brewing in the commercial real estate industry and how we feel, what we think that will look like, in the future. Yep. Before we get there, let's just talk about the region we're in. We're here at the Southwestern Ontario Real Estate Forum. your home turf.
Yep.
Maybe just talk about how it's going right now in June 2025.
Yeah, so I think that we are in a moment in time. I think that if you look at it historically, we are in the midst of a bit of a correction. I think we're on the back end of that correction, though. I think we're starting to enter the phase now where it's truly having that price discovery. And I think that inevitably what's going to happen is that as we see an increase in transactions, we're going to get a sense of where the market is, and we're going to keep going. I think my comment overall that I would have when you're looking at existing assets, we've seen more of a plateau versus a significant drop. I know there are a lot of projections out there, but you still need proof. You still need transactions in order to prove where the actual values are. I think face rates for leases are still staying fairly flat. I think the tenant inducements are going up, but I also think that creates a significant advantage for the tenant right now, because I think that's going to go away. I mean, right now we're not doing a ton of building. Not when you look at the inventory for Southwestern Ontario and the current vacancy, there isn't a ton of building on there. So as that absorption starts to go, we're going to end up in the exact same spot.
And vacancies aren't wide anyway.
Correct.
Yeah, I mean, if you go from 3 to 3.6, it's a 20% growth, but by no means is that an unhealthy market.
I remember, you and I coming into the business around the same time. Industrial vacancy at that point, a healthy market was 5.5 to 6%.
A functional market, yeah.
Correct.
Yeah.
And so now, I mean, it's the same as anything. If you look at land as an example, where some people state statistics of, let's say it's a 30% drop in value or 40% drop from the peak, but theoretically you were probably 20% over a healthy market with regards to pricing. So is it a true 40%, or were we just correcting off of a 20% off of a healthy market? I think it's assessing and removing the emotion when you're figuring those numbers out. But Southwestern Ontario, especially after this last, call it bull run from 2011 through to today or 2023, this became a core part of people's portfolios, of users' head offices. Southwestern Ontario is core right now. Population growth has increased that way. The logistics and access side of it has gone that way. Affordability is a perfect one. Like, it is a core area. It's no longer that tertiary market that it was 20 years ago. This is a core part about where people consider for making decisions.
Let's just do real quick geography. Southwestern Ontario is kind of the whole horseshoe around Lake Erie and all the way down. Total population?
So we're now we're about 1.9 million people.
Yeah, it's around 2 million total, right? So you think, that's double the size of Edmonton or what have you. So a major, whatever that percentage is, 7% of the Canadian population, or whatever it works out to. So a significant number of people, and so deserving of that, you call it sort of core location.
And at a time that, though geographically more spread out than, let's say, some of those other municipalities or Toronto even, you can also commute, though. I mean, in 30 minutes, you can be from one municipality to another one. 30 minutes, you go a few blocks in Toronto. Like, it's still all relative.
Or less.
That's right.
It takes an hour to go from Toronto to Toronto.
Before we move on from broker's side or Southwest Ontario side, we've been hearing that the bid-ask gap, which has been a big problem for the last couple of years for transactions, we're hearing that, I guess, reality started to finally settle, or market forces are just dictating people need to actually move on sales now. Are you finding that gap is not as big as it was, 18 months ago?
Yeah, I do think that it's coming together, but I think that that's a natural cycle. When you look at natural cycles in the economy, really since the late 1800s, and you track those, they run through the same pattern almost every single time. So there's a disruption that happens that kind of forces it. Could change, could be a dozen different reasons as to the why, but it creates the same thing. It kind of triggers a price correction. You go through an unknown period of time where transactions fall off because sellers don't want to sell their properties too low because they don't know where the value was. 12 months ago, it was worth 30% more than what it may be worth right now. But buyers also don't want to pay if the market's still going down. So that's where you get the transaction drop off. Then what happens is you start to be forced. So that could be bank related. and that you start to see banks forcing with the debt that's in place that they're forced to do deals. That starts to set a market. It's forced because people can only stall their businesses for so long until they then make that decision that I need to expand or bring people back to the office or whatever that ends up being. Either way, transactions are almost forced. It's those few transactions that starts to set price discovery. You need the price discovery in order to then know where your starting line is to then go on the next bull run. We are just starting now that price discovery period. We're starting to see a few transactions. More properties are coming onto the market. You're seeing more leases get done with landlords putting in the TIs or the face rates, the tenant incentives or the face rates in order to get those done. That's what's going to give us that price discovery. We're well on that way.
Into the next cycle.
Correct.
I have a half thought, and I don't know how to make it a full thought, so I'm going to ramble this out, and Ted, you're going to have to help me. Because I disagree, kind of, but don't disagree at all. See, I told you it's a half thought. It's the psyche. So let me just talk it out. So agreed, cycles, you can look back hundreds of years, and the cycles are kind of the same, and it comes out the same, and there's lots of lessons learned. The difference in this particular instance is that the cycle length was massive, like triple any other historic cycle. So, and really, we haven't really had a challenging. We really have the end of a cycle since the 1990s. I mean, you can talk about the world financial crisis, but that was a hesitancy, not the end of a cycle or a resetting, right? So it's really, I mean, there's a whole generation, all of us at this table included, who've never really been through challenging real estate environment, and so I'm curious how our individual and collective psyches play into our interpretation of how the cycle finishes and turns back up. And then, this is where I'm kind of challenging you. I feel like we've all been bred to be very optimistic in the commercial real estate environment because in our experience, rents go up, interest rates go down, cap rates go down, values go up, like everything's always rosy. And so we've had a little bit of a blip here, but I mean, we'll go back to that rosiness, of course, right? Because that's the way that real estate works. And I worry perhaps that the future of commercial real estate for a long time, because we've had such an incredible bull run for effectively 25, 30 years, that the next lengthy cycle, which may be 10 or 15 years long, is not any kind of bull run. It's just flat stability. And so we're all setting ourselves up for failure, thinking that there's this great uptick coming. And it's like, no. It's just going to correct itself. And then if you take the 50-year average with a giant bull run and then a 15-year flat run, it ends up being pretty healthy. You know what I mean? Because we've had an unhealthy growth in all corners of real estate for the last 20-something years, right?
I do.
Do you follow me? Did I fill that hole in?
I totally follow you.
Good times create soft people, or that kind of idea.
I guess so.
I do follow what you're saying. I don't completely agree because with the theory that, okay, so let's call that next bull run or next part of the cycle that if it's anticipated that it's more of a flatness or less of a curve up than what we're used to, I think the less of the curve up, that makes sense. I don't think of flatness because theoretically, if you were going to go and anticipate that there's a flatness, all other variables would have to stay flat because you can't have increase in population. You can't have increased growth in the economy. All aspects would have to stay flat.
Yeah.
Construction costs would have to stay flat. You would have to have just enough delivery of product that you don't offset a healthy market, because in a moment where it is supply and demand drives a healthy market, you would have to anticipate that all variables stay flat in order not to affect that supply and demand.
No, and fair. And there's the income level or revenue level that you have to add into it. I would just say this: there's a pretty close correlation between the declining interest rate environment over the last 30 years and the growth of real estate. Yep. Interest rates are not going down again. Interest rates will stay flat, plus or minus, for the next while. Yep. And so if using that as a barometer, I think there's going to be, let's say, less of a growth environment that we've experienced over the last 25 years.
That
right?
I agree with. I'm fully in line with you on that piece. I agree.
So those hoping for that $5 per square foot rents in downtown Toronto or $18 or $20 rent in industrial and wherever, like those I don't think are coming back, would be my suggestion.
No, you're What isn't going to come back is that uniqueness, and I do think it is a bit of a once in a generation in the amount of lift that we had in values, specifically industrial rents, in a very short period of time. The same way that we were starting off speaking about 5.5% vacancy at the start of my career. Those rents at that same time were $6 a square foot and had been for 20
better
years.
products. Yeah.
Yeah, exactly. And then all of a sudden, we started to see 30% plus bumps that people were underwriting assets at projections that were, rents at the end of terms that were going to be 40% higher than what they are today. That we won't see. I do believe that, I don't know if it was falsely compressed for a very long period of time and the market was catching up to where it could be, which that might be the case when you looked at some of the larger, especially North America or US markets. Our rents were severely behind where they should have been.
So let's summarize, if I could. Cycle will complete at some point. Yep. It's not a hockey stick, resumption, and we will likely experience modest growth through the next cycle.
I agree with that.
On all asset classes. I don't think you could pick one asset class where that wouldn't be true if you think about it. Maybe office, but back to home. Let's not go down that road. No. Back to home. Back to office. Let's not go down that road. But anyway.
So how does this impact the brokerage business then? Because for the last 10 years, every investment that you would have helped facilitate was a home run. Rents just grew and grew. I mean, commissions, of course, grow along with that too. What does this do going forward to the brokerage business, given that it just makes everything a little bit tougher?
Brokerage business is a little bit different because we're transaction based. So in other words, we're not returns based. If somebody is going in, if you have a asset manager or a family office or a personal investor who's going in to purchase a building, that relevancy that you're staying more or less flat and you're not seeing, let's say, 3.5% or 4% increases year over year on your rent, that affects it because now your returns are affected. Brokerage is transaction based. In other words, I'm going in there and yes, we aren't necessarily going to see a lift in the same way on a value of the transaction, but I do think that the volume of those transactions will stay steady because real estate trades hands. And so that service side of the business, being able to supply the data and the guidance, the advisory needed for people to do those deals, that stays consistent. I think the biggest thing that changes or matures within the industry inevitably ends up being, what are the services required in order to do our jobs and do them properly? And what doesn't meet the expectations of those investors?
The idea of playing your cards as best you can. Obviously, you're a transaction-based business. Your clients are a return-based business, but really they'll figure out what makes sense and does not on the investment side, and you'll facilitate that to the best of the market's ability.
You could argue that it's no different than let's say the securities trading industry, right? Trading doesn't go away. Allocation of funds changes. Portfolio diversification changes. But the advisory role in order to help facilitate that stays steady.
People need help. They need guidance. Right?
Yeah.
They need facilitation.
Real estate's complex.
And simple.
But to that point, no, but you're absolutely right, because I mean, staying on the securities or the advisor, well, let's say wealth advisor type industry, we've seen that maturity almost 20 years ahead of the real estate industry. From a standpoint of, you could have 1,000 people sitting on the New York Stock Exchange trading floor, and the way that they did deals was yelling buy sell orders at each other the whole time. And the only reason that somebody was investing into corn commodities was because they knew or anticipated something somebody else did it. Fast forward to today, you can do direct investing on things like Wealthsimple and platforms like that, because that data that people needed to have 50, 60 years ago, you got that and you kept that to your chest. Now, information is commoditized. I can buy that information. I can buy the anticipation of what corn is going to do and know how to invest into it. So in a world where information is commoditized, it can be licensed or purchased, it can be aggregated, how does that change the world of the advisor? And that, I think, is what the securities industry and the wealth advisory industry has already seen with things like Yahoo Finance and Bloomberg terminals and all those things. If those same investors are now coming into a world of hard assets, they have that same level of expectation. How do we meet that expectation? How does that change people's decisions? I think that's where, though simple, because our transaction has not changed, what's needed in order to do that, though, that's what's mature.
Well, and in the Canadian context, obviously, we're light years ahead now in the data front, but only in the major markets.
Yes.
Once you start getting the smaller markets, that all goes away. Then it is more old school real estate. You got to know somebody who knows something to make a...
Well, and there's still the, deal over a nice dinner, handshake, right? Like friendship, relationships, build trust. Like that part is difficult to get past, right?
I don't think that will ever go away for our industry. The only reason the securities industry was able to do it is because they had automated, transparent marketplaces.
It's commoditized, right?
That's
it's not commodity, it's commoditized.
Correct. Right? And we're not, as an industry, we're never going to be that way. Like it's very difficult to get to that point, especially on the user space. I mean, you hear talk about smart contracts and everything else. Even if you put all leases on smart contracts, it doesn't take away that, as you say, the transaction over dinner.
We did a podcast 8 years ago now using with the concept of, block and chain technology.
Blockchain.
What did I say? Block and chain? Yeah, whatever. Same thing.
Yeah.
How that technology...
Abhishek Sinha was the guest.
I can't believe you remember that. Good work. Yeah. And how, that technology and smart leases is going to revolutionize our business. And I don't, it's not happened. Maybe it will, but it's...
Well, I'm involved in another group, and we're one of the first ones to be fully regulated by across Canada with the security regulators with that concept. And what's driving it is the market need of investing into alternative assets, of putting more regulatory oversight over syndications and LPs. It's bringing safety to the investor and giving access to more people. So conceptually, I think that the industry is continuing to fast forward or mature towards that. I think 8 years ago, the technology nor the access to data was available in order to do it. I do think that that's changing and changing rapidly. What I don't know, and what the interesting part about all of this, and back to our comments about hockey sticks or staying flat or what does the industry know, there are variables in there that are very hard to predict. How does artificial intelligence, how does robotics in factories and 3PL services, how does that actually change? If you were to have, and now this is going far down rabbit holes, but if you were to have full autonomous vehicles, I mean, Tesla was coming out, I think there was news reports with the robo-taxis and everything. If you had full autonomous vehicles and therefore didn't need downtown parking garages, cars came up, they dropped you off at the office, they went and parked on contaminated land in the old business park in the outside of the downtown, and you redevelop the existing parking garages for residential or for buildings, how does that change the look of a city? There's a lot of variables there that could happen in, let's say, the next 20 years that are hard to anticipate.
So on the whole, the disruptor front, you view more positive than negative in terms of what's coming?
I'm quite positive on it. I'm a big believer in it. I think that we have seen it in many other industries. I think we saw it in the retail industry with groups like Amazon. We've seen it in the hoteling industry with groups like Airbnb. That maturity in order to create access, in order to create transparency, flexibility, to truly put the client first with regards to deliverables of data, how you present that to people, how you analyze that. I think the more the better. I think that it puts our industry on a different level when we can service those clients to that point. Because when you look at some of the sizes of the funds, Blackstone, BlackRock, groups like that, who have trillions of dollars under management, and they are taking major steps into the commercial real estate industry, we need to be able to service that and service that well for them.
Why are they doing that?
So I think that there's a few ways. I think that part of it is that when you look at a lot of the investor letters that are going out, all of the thesis that are going out right now, traditionally portfolios for investors have been focused on kind of 60-40, 60% stocks, 40% bonds. Now what the recommendations are more in that 50-30-20, 50% stocks, 30% bonds, but 20% alternatives. Alternatives is what has been difficult to access. So that's your private debt, that's private equity, hedge funds, real estate. The same way that when I was coming into the business, no university offered a real estate course. Then University of Guelph started to offer it, Western, others. And now people are going through, and a lot of the people we hire have gone through courses like that. Now we're starting to see the same thing around investing from the securities and the advisor side. People are learning as much about alternative assets and specifically into commercial real estate that was never there before, because it was never an asset class that was heavily invested into. And the only way to truly do it was public REITs.
Right. And so the sophistication of data, which you're alluding to, has to get down to the asset by asset level, though, in order to really make this work.
And that is the difficult part. Right now, it is extremely manual in order to do data collection.
The CoStar's operating budget would be humongous.
And they have guys driving around, taking pictures of places, making phone calls, asking about lease rents, but they don't necessarily have the full scope and picture of what's transpiring.
The hard part. Yeah. And that won't go away. Like that, in my eyes, even with everything that you were saying, blockchain and smart contracts and all that, I don't see how that goes away. I think that you could put every AI piece in there and you still couldn't scrub the data to aggregate it to be 100% accurate.
So I got my own input for you. So
you got a solution for us? Let's change the world.
It's not. No, it's a component. It's a component. It's all bits and pieces. First National, we're members of GRESB, which is sort of an environmental, is a North American committee for lenders. Yep. On just how we solve, the requirements for reporting on ESG, but it's really about, decarbonization and tracking the carbon footprints of every individual asset. And in Europe, of course, who are a decade ahead of us, yep, there's mandatory reporting on these types of things, and it is regulatory, top down, European Union down to European Union members, down to the owner operators of real estate, where they have to basically figure out what their building footprints are and then report it on their tax filings every year. Yep. And it's just that, I think that is ultimately what we're gonna have to go now. They've got climate change initiatives, and so that's why that's being pushed, but that can be transported into any type of reporting you want, any sort of data reporting. So whether it's financial reporting and or energy efficiency or whatever it may be, it has to come, I think, top down. I think that's the only way it works. So they're not going to volunteer. No, people aren't going to voluntarily do it. And let me just finish the thought here.
Please.
Many of our sophisticated owner operators, like our institutions that are global in nature, they'll do it because it's to their benefit for attracting capital. The majority of real estate in Canada is privately owned, small privately owned. They have no incentive whatsoever to provide this type of data.
No, but I think that so you're right. I think that it is top down. I think that is where the driver is. That top can be regulated, which is exactly what's happening in Europe, where the expectations are. I mean, it is now for an occupier who's going into a space, if you aren't going into a certain building and to be able to hit the requirements that you need to, then you can't operate. And so therefore, that's an attraction to the A class, the flight to quality. That leaves the B and the C class buildings. Do you heavily invest? Do you repurpose? What do you do with that? Driven by the regulators. I think it can also be driven by, again, the large pension funds. And that isn't always necessarily just sustainability and carbon credits, but it's what you're saying. It could be all data points in whatever would be variables there. I think it can also be driven by shareholder value. If we, as a society, and you see it a lot in the life co's, insurance companies, groups like that, where they take more of a holistic view to investing. And so what they'll do is, in some cases, they will have full audits or analysis with regards to their footprints and on the ESG side of it. And there's a rating system. So inevitably, if you are a publicly traded company, you're within their portfolio, that factors into their overall audit, factors into their overall rating. So if I have a company that is pulling me down from the rating that I need to be, I'm going to dump that stock. Theoretically, if you have a bunch of pension funds or life co's, et cetera, who repurpose and pull out of that stock because it's bringing them down, I am going to be driven to try to put in those sustainability features to then lower my carbon footprint so that more people will invest. So in that case, the top down is my share price. I need to bring share value to my investors.
This is the carrot versus the stick argument, I guess.
My brain's going somewhere else, I think. my data, your colleagues' data, my colleagues' data, and other sort of providers, Altus, like CoStar, if we all got together and put it all into one big sophisticated data lake, we'd have all of this information. The problem is you're sitting on some data, I'm sitting on other data. Collectively, we would have every single data point on commercial real estate across the country. How do we do that?
I don't think we can. I think that I don't know what the current market cap is, but CoStar has been spending 20 plus years and is now a $30 billion $30 billion market cap company and still have not got it right.
Yeah.
Not got it right for every asset class, every transaction, every municipality. I think that it becomes very difficult on a macro level in order to do that and do that right. I don't know if it ever is truly possible, because the variable that always plays into resourcing and technology is people, and it always comes down to people. And until you get everyone on the same side, and I think there are a lot of geopolitical issues out there today because not everybody can get on the same page.
So here's a future world where machine learning and AI get sophisticated enough, or I just take my data and your data and everybody's data and throw it into some sort of digital network sequence and just go, here, fix this, and out pops the perfect results for us, right?
But data silos have value. That's the other two. Hoarding information has value. I mean, the MLS system was basically predicated on that.
I feel like
decades ago, hoard the information.
I feel like we need Sarah Siegel here. She would have an opinion on this right now, wouldn't she?
Simply DBS for anybody who doesn't know Sarah Siegel. Wow, I don't know where we go from this. Was that it? Yeah.
Where we are. What are we talking about?
Yeah, no, it was great conversation. Aaron and I always happy to discuss the future state of real estate, discuss disruptors.
We spent a lot of time talking about
and we want it now, and it just doesn't seem to be happening at that pace. That's the only disappointing side to it. But I do see everybody here at the conference kind of heading over to lunch, which might be our signal that our time has come to an end. Ted, you have a panel coming up later today.
We do.
Great luck on that one. Thanks so much, of course, for First National for powering the podcast. The real estate forums are hosting us here in London at the Southwestern Ontario Forum. But best of all, our guest. Thanks for coming today.
Thank you so much, guys. Really appreciate it. It's
Thanks,
always great
Ted.
getting together.